Yeah.
Sure. All right, good afternoon, ladies and gentlemen. Are we ready? Recording on?
It's on.
Okay, good afternoon, ladies and gentlemen. My name is David Tam. I'm the Chair of the Funds Commission. Welcome to this November 30th, 2023 meeting of the City of San Diego Funds Commission. I'm going to do a quick roll call to confirm commissioner attendance. When I call your name, please say present. Commissioner John Peel. Present. City Treasurer Liz Graham.
Present.
Thank you. Your attendance has been noted. For the record, we have a quorum consisting of Commissioner John Peel, City Treasurer Liz Graham, and myself, Commission Chair David Tam. Also present are Marguerite Madoff, Deputy City Attorney, Allison Bonney from Northern Trust, Sylva Thomas from Northern Trust, Jeff Niff from Sequel Marco Advisors, and Andrew Grimaldo with the Office of Boards and Commissions Liaison. Why don't we start with the approval of the minutes for the August 29th, 2023 Funds Commission meeting. Are there any changes to the minutes that were provided? Hearing none, is there a motion to approve the August 29th, 2023 meeting minutes? Approved. By John Peel, second by Liz Graham, was approved. We will now take roll call vote. John Peel, aye. City Treasurer Liz Graham.
Aye.
And myself, on this period, vote aye, that motion passes. We will now move on to the agenda, starting with the informational items. We will take up item number 1. That's a report from Northern Trust regarding Mount Hope Cemetery Fund investment and performance review. We're headed Allison Bonney from Northern Trust to present. Allison, over to you. And you're on mute, by the way.
I can finally hear you all. Great. Can you all hear me now? Okay, let me share my screen. Okay. So we reviewed this information several weeks ago. So I'm going to go through it more quickly and really give you an update on where the market stands today with the portfolio. These are numbers as of September, but I'll update you on that because the environment has truly changed in the past almost 2 months now. So last quarter, the end of the quarter, we talked about what happened in the markets. I'm not going to go through all of this other than to say as we had a lot of volatility, and you can see through the third quarter, through July and August, the markets were up and then down as concerns about.
Allison, sorry to interrupt you, Allison. We're not viewing your screen. If you could share your screen.
Okay.
Excellent.
Do you see it now?
Sharing your
Yeah.
Zoom window, you might want to put.
Yeah, let me pull it back up here. Here we go.
Okay.
How about that?
Perfect.
Okay. So a recap of the third quarter, global markets were down 3.3%. Again, a lot of volatility during the quarter, but towards the end of the quarter, things tailed down, primarily due to the concern that inflation still was not under control. And then we had other threats on the horizon, including the strikes environment, as well as the threat of a government shutdown. And we went through some of these statistics. As far as overall, let me see if I can reduce this, market returns. Is this visible to everyone?
Yes.
Okay. So year to date through the third quarter, what we saw were equities, were down just for the quarter, 3.2% in the US, 3.9% outside the US, emerging markets sort of hanging in there, but emerging markets were already struggling. And then on your fixed income side, again, we saw rates start to increase again with concerns about inflation. So we saw investment grade bonds deliver a negative return during the third quarter of 3.2%. But what it translated into overall year to date was a negative return in investment grade bonds, which is important for your portfolio, as this is a very conservative portfolio of negative 1.2. You do have some high yield in the portfolio, so that held up well. That's our most significant overweight in client portfolios. And then we saw the equity markets back off after having had a very strong first quarter. And again, just to remind everybody, because time seems to go by so fast, that during the first quarter, we saw our tech stocks take off with the news about AI, artificial intelligence, and the implications across the tech stock universe. And it was really the Magnificent Seven that led the market in that period of time. So that slowed down during the second quarter, the third quarter. So we see these negative returns then through the third quarter. I wanted to stop here for a moment and just help everybody understand that the months of October and November have been pretty much unprecedented in terms of the amount of growth or rebound we've seen in the markets. The reason being, obviously, we've seen the inflation numbers start to move in the right direction. We've seen the employment numbers starting to loosen up a bit, not as strong. We've seen consumer spending keeping the market very high, but again, we've seen savings rates come down, and so that was helping, but there could be an expectation that will change going into 2024. And that's probably one of the key indicators that we're looking at right now, which is the consumer has been very resilient. They've been holding up the economy. But again, we'll see where the numbers come in through, obviously, the holiday season. But then in the first and second quarter of next year, we'll have a clearer picture of what's really happening in terms of overall GDP growth numbers. Again, good news is bad news with some respects in terms of market certainty. But I would say the general consensus right now, whereas many, Northern Trust included, was thinking that the Fed likely will not be making any cuts this year or well into next year. I'd say the general consensus right now is if things stay on target, and we had one of the Chris Waller, one of the Fed chairs, being very dovish a few days ago, basically saying that with inflation cooling, they would expect cuts to be coming sooner. So that's really what's leading the pack right now in terms of what the markets are anticipating, and therefore how they're developing, how they're performing right now. I will say, since the end of the third quarter, your portfolio is now at 11.6 million. As of the end of September, it was at 11.2. So you've seen roughly $400,000 of growth there. This is what the portfolio looked like at the end of September. It hasn't really changed significantly since then. You can see that, your target investment policy is 34% in risk assets, 66% in risk control assets. We've maintained a heavier tilt towards your risk asset bucket, but within your risk asset bucket, specifically within core equities, we've been overweight US equities, sort of neutral developed markets, but underweight emerging markets. And then within real assets and high-end high yield bonds, that's the other two categories, we're sort of slightly neutral to real assets, although somewhat overweight to natural resources. We do believe that that's been in there as an inflation hedge, and it's done relatively well. And then high yield bonds, you just saw the number on the prior page, are the most significant overweight we have in your portfolio. And high yield bonds have held up extremely well on a risk adjusted return basis. So here is the overall portfolio, again, as of September. And these are our positions with respect to overweights and underweights. And again, just to frame it up, slightly overweight cash in portfolios, neutral in investment grade bonds, underweight TIPS, inflation protected securities, overweight high yield within your fixed income categories, within your risk assets. Again, you're not there exactly, but We haven't moved you to an underweight US equities, but this has sort of been Northern's directional recommendation. I'm glad we haven't moved this portfolio there. But these are the recommendations, and basically staying neutral on listed infrastructure, real estate, but overweight natural resources. So we've been dialing down risk in the portfolio, but not taking it off the table. And again, given the uncertainty in the market, this is a long-term investment horizon. The risk has been always, we tell clients, if we're reducing risk and the markets continue to move ahead, we may have left some money on the table from a benchmarking perspective. So too much underweight risk has been our biggest concern. I think the other biggest concern continues to be how things will unfold in the Middle East. The markets have been taking it relatively benignly, oil prices seem to have been under control, coming down. But that is clearly from a longer term perspective. If things do expand more globally in terms of the crisis, then the economic fallout across industries is probably the biggest risk we see in the markets today. In terms of Fed activity, it appears like if we have a soft landing, which looks like we may, then it's been appropriate to continue to maintain risk in the portfolio and to stay fully invested. And the rest of this packet pretty much goes through the general numbers. I think I showed you your performance numbers here, but let me go through. So in terms of the detailed performance, you can see all of the various asset classes that you're in, the various fund assets. But in terms of overall performance through September, on 3 months down, net of fees 2.7%, so pretty much sitting right on top of your policy benchmark. Year to date, the same thing. On a 1-year basis, you're running ahead of your benchmark. Similarly, on a 3 and 5 year and 10-year basis. Now, these numbers will change regularly based on a month to month, but I think your 1 and 3 year numbers are pretty indicative of how well the portfolio has been doing. So I'm going to stop there and answer any questions, but I do know that another topic we were to address today was how the portfolio is positioned vis-a-vis your carbon footprint. We do have some analytics here that I can walk you through. I don't know if you'd like me to do that now or hold off until later, but let me first open it up to questions.
Yeah, it's later.
Okay, that'll be later in the discussion, Allison.
Okay.
But questions. So I have a question. What do you attribute, or what does Northern attribute as far as the spike in yields in 1 quarter? Such a sharp spike in the 10 and 30-year treasury. I was looking at
What drove those yields? Absolutely concerns that that inflation was going to continue. And and we heard a lot of folks, the talking heads that you see on TV talking about the entire yield curve shifting up. So as you know, the 10-year went up as high as 5, slightly over 5%. Now it's back down at 4.3. That has made, year-to-date numbers for, your 10-year or even your longer duration securities, having that come down from 5.5 all the way back down to 4.3. You're seeing numbers of over 11%. It's totally attributable to concerns about inflation, the stickiness of it. What about oil? But it seems, given where the numbers are coming out now, that the Fed so far has been doing a pretty good job of containing it. But again, we see those numbers are all over the map right now. And those are extraordinary swings in terms of yield expectations or inflation expectations.
David, if I can jump in, I was actually reading something about this. This question has come up a lot. It's
Yeah.
like, why did this happen?
it's super nice. Yeah.
There's something about apparently there was a lot of long treasury bond paper being put into the market by the government. So that drove yields up because prices had to be cheap so they could sell all that stuff. So
But
I
then
think-
they were also absorbed. The market, the expectation was that they wouldn't be absorbed,
Yeah,
and yet they were. So you saw the swing come back down. Good point.
is kind of what's behind this group of Republicans that say we're spending too much. You know, it's this kind of stuff that they look at and say, well, you know, look at this problem here. So there's some element of that, along with what Allison was talking about. It's just at that point, this 2 months ago, people were like, oh yeah, it's going to be higher for longer. That's completely flipped around now.
Right. So, and I think I've mentioned in prior meetings, you know, how, I mean, it's sort of unprecedented. How do you manage the duration and your fixed income exposure in this kind of a market and where you see a risk control asset, right? Your fixed income is supposed to be the ballast in the portfolio, and yet you've got an enormous swing. So we've been managing sort of as a barbell, having exposure to both, but sort of sticking with the ag mid. So if we see longer duration, which it just did, outperform as rates came back down, you know, you got your appreciation in your bond portfolio there. If rates continue to go up, your shorter duration bonds perform fine as well. So we'll kind of see, we'll know in another, obviously, few days how the strategy has borne out.
You mentioned that,
John.
sorry, yeah, you mentioned that the portfolio is up significantly from these numbers, but the allocations are still within our target. I know it's for a couple months into the quarter. Is this an inflection point, or we need to do something, or do you think we're?
So again, so we're sort of been letting it run, and there's nothing to say that, but we will. I mean, I was just listening to a call this morning. Again, what on the horizon might make us want to sort of either add back to risk assets more, or, you know, you're already overweight versus your policy statement to risk. I think what might give us pause is if we saw things probably in the oil markets more than anything else really start to create some turmoil, as well as geopolitical risk just in China and whatnot, that might say, you know, it really seems like we probably need to go back to reduce overall risk in the portfolio. We just don't see those signs right now.
Is there a threshold where it will trigger a rebalance because we're almost 10% above our stock target?
The trigger would be, first of all, we distribute cash to you monthly. And so I think that that's an important consideration. A lot of clients will just do it once or twice a year, so we're not too concerned. You know, we just make sure we've got enough powder there. I think if we were to see, you know, the market start to move down, I would just start to raise cash actually in the portfolio, just to make sure you have several months at your disposal. So, and that would probably come from your risk portfolio, it would come from your equities.
Thank you. Are there any other questions or comments from the commissioners? City Attorney. No. All right, Ms. Bonnie, thank you again for providing the Funds Commission with this report.
Sure.
Note for the record that this is an informational item. There will be no commission action. We will now take up items 2 and 3 together. Item 2, report from Siegel Marco Advisors regarding business and economic outlook, and the report from Siegel Marco Advisors regarding the performance of funds. I will turn it over to Jeff Nipp from Siegel Marco Advisors to present these items.
Okay, thank you. Since I'm not on Zoom, I can't share, but I'm starting on page 57 in PDF, page 57 in the meeting packet, 57 of 300. That's where my report starts. So Allison covered a lot of what's been going on in the markets. A couple things I just wanted to hit on. So on page 60, couple things in the quarter to date column, you can see Russell 1000 growth, Russell 1000 value were almost identical. But year to date, it's 25% growth and less than 2% value. So that's the Magnificent Seven. That's the big tech companies. that for the first half of the year really were dominating. And I think that's come back this quarter. But during the third quarter, it was pretty even across the board. Smaller cap stocks were a little bit worse. And down in the bottom right of that page is the sector returns. This is kind of like last year. Energy was positive, and almost everything else was negative during the quarter. And that's because oil prices were going up. And that's very different than what we saw in the first half of the year. And again, that's all turned around again so far this quarter. But just a couple things to note. The next page is the international markets, and a similar picture in the sectors. Again, energy was up double digits. Financials were also slightly positive, but I think pretty much everything else was negative. And you're going to see that reflected in your manager's performance in a minute. 2 pages further on, I think, we've got the yield curves. Again, Allison was talking about this, but there's the picture in the upper right. The green curve is where we ended September. The yellow curve was where we ended June. The short end, hardly any movement, just a little bit of increase. The Fed did their one hike in July. They haven't done anything since, but those longer term rates went up. And that was, people talk about the market doing the Fed's job for it. Mortgage rates were up. Once we got into October, 10-year Treasury crossed 5% yield, and Allison said it now down more like 4.3. So it's really, really sharply turned around. But that's what happened in the quarter. And the next page, you see that reflected in the return. So the aggregate index down over 3%, bringing it negative year to date. It now is positive 2% year to date. So it's turned around substantially so far this quarter. And when I say this quarter, it's really this month, because October was, I think the S&P 500 was down 2% in October. The aggregate index was down 1%. So it's really been all about what's happened in November. And it's primarily because of those good inflation reports that came out. So I think next quarter's report will look a lot better than what we see here in absolute return terms. But we still have a whole month to go. On page 67 of the PDF, and again, we've got several funds here, but they're all pretty similar. Here's the allocations. All of them are a little bit overweight in U.S. equities, a little bit underweight in fixed income, and the amounts range from about 2.5% to 4%. Their international equity is pretty close to its target, generally less than 1%. I do want to keep an eye on this. 3 of these portfolios we take quarterly distributions from, so we're always able to do a little rebalancing just by taking what's overweighted. The other 3 we don't. Everything's still well within its ranges, but I think given what's happened this quarter with equities, especially domestic equities, really shooting up, we're going to want to look at this, and we may want to look at maybe doing some rebalancing next time. So I'm just making a note of that for myself, that we might have an action item next time to deal. But right now we're well within the ranges. That's fine. Skipping ahead 2 pages, so this is page 69 of the PDF. We have the performance. So again, all these portfolios are very similar. Here, down 3.8 for the quarter versus the policy index is down 3.3. We'll see in a minute what drove that, and I can tell you it was fixed income. In equities, you got the S&P index fund that's tracking right on as it should. Boston Trust continues to do a good job. In a down quarter, you would expect them, a somewhat more defensive portfolio, to outperform, and they did pretty substantially. Still behind year to date, and that's that first half of the year, very growth oriented markets in the first half of the year, but their longer term record is really strong in the almost 3 years now that you've had it. So this is performing exactly in line with expectations, which is good. The next page is international equity. Here's a pretty good, so this overall international equity was pretty much right on the benchmark. You had outperformance from Dodge & Cox, which is the more value-oriented manager. And I talked about sectors. They were overweight energy and overweight financials. And looky there, they outperformed by 2.5%. Still negative absolute returns, but substantial outperformance. American funds, a more growth-oriented portfolio. And theirs really was financials. They're underweight financials. And the financials that a lot of the financials that they own are actually more Asian financials, which kind of got hit by the issues in the China property market, even though they're not directly related. The growth index for international was down over 7. This portfolio was down 6.3. So again, kind of in line with expectations. I can tell you this quarter, they're outperforming. I have them at several other clients. And like everything else, that performance has really turned around this quarter. So both managers year to date, as of yesterday, are now ahead of the index by 1 to 1.5%. But this is kind of a classic style diversification quarter that you see. And then we have fixed income. So this is the source of the underperformance. Western, as we know, is long duration. They're about 7.5 years versus about 6 for the index. That will have helped them this quarter. So again, for forecasting what we're going to see, but that definitely hurt in the third quarter. MetWest also is long duration by about a year, so more like 7 versus 7.5 for Western. So that hurt them, clearly not as much. Also, they got a lot of exposure to mortgages. That didn't help. That part of the bond market underperformed other segments. So they underperformed a little bit during the quarter. But Western is this sort of boom and bust type of portfolio. So this was a bust quarter, and but we had seen some good quarters right before that. But it was really that fixed income performance that was the driver of the overall performance. Let me also say, while we're on the bond managers, so I had mentioned last time, I think this had been announced just like a day or two before our last meeting, that 2 of the MetWest portfolio managers were going to be retiring, one at the end of this year, one at the end of next year. Our research team has talked to them once already, right after that announcement, and they're going to be doing a meeting in the first quarter to meet some of the other people that are going to be stepping up to take place. They're not bringing people from the outside, although they did hire somebody, but not specifically for this. But there are some changes. David, you asked me last time, should we do something? In a sense, I want to wait and see what our research team says after that meeting. But I've been thinking about this some more, and depending on what we talk about with fossil fuels and all that stuff, it might make sense to look at some potential alternatives here. And what I'm thinking is, you've got Western, which is an aggressive manager. They'll be aggressive with duration, with sector allocations. It might make sense to have a more conservative, especially on the duration side, somebody who tends to be more duration neutral, and more of a sort of individual security selection type manager to balance out. Because this quarter is an example where, for their own reasons, both managers said we want to be long duration. That hurt both of them. Now sometimes they'll be right, but it might be helpful to have a little more diversification in strategy. I think that, combined with these changes, personnel changes at MetWest, I think it might make sense to at least look at some alternatives for MetWest and see if we want to make a change. We'll have input from our research team too that we can factor in. This isn't, it's not a disaster. We don't have to do anything right away, but I think, just kind of being proactive and thinking about the structure of this portfolio, that would make sense. So it doesn't require any action today. That's, again, just for me next time to bring some information. I think that was really it. Questions?
For the fixed income funds, if the durations are 7 years, we're looking at the 7-year total return. Shouldn't it be giving us at least the yield in that time frame? Does that make sense? So if the duration is 7 years, shouldn't our total return be the bond yields throughout that duration of the mutual fund?
Well, the problem is that the yields were so low, those returns. So the returns have been, negative price impacts
Yeah.
without a yield cushion. I actually looked up the yields. And it depends on how you measure them, but just trying to measure things consistently. That I think the SEC managers to do a 30-day yield.
30-day yield.
Okay, so the index is like 4.8, MetWest is 5.3, Western is 5.7. And those are as of a couple of days ago. So just to give you an idea, and I think that's pretty typical. Western, you pretty much count on they're going to have a pretty substantial yield advantage over the benchmark.
Other questions? Okay. Thank you for the update, Mr. Schnipp. Note for the record that this is an informational item. There will be no commission action. We will now take up items 4 and 5 in succession. Items 4, Allison Bonnie, presenting the impact and feasibility of implementing potential divestment requirement for Mount Hope Cemetery Fund, followed by Jeff Neff, presenting item 5, impact feasibility of implementing potential divestment requirement for the Edwin A. Benjamin Memorial Fund, Jane Cameron, La Jolla Library Fund, Philip L. Green Memorial Fund, Los Penasquitos Canyon Preserve Fund, Gladys Edna Peters Memorial Fund, and the Effie E. Sargent Memorial. I will hand it over to Ms. Bonnie.
Okay, everyone, I'm going to start sharing my screen again in a moment. Can everyone hear me?
Yeah, thank you.
But let me, this is a topic that is, as probably many of you know, is fraught with all kinds of issues that really start with an understanding of the macro term ESG, environmental, social, governance, companies that have high scores relative to these 3 criteria. Over the years, a lot of very large institutions, particularly in the educational area, have been insistent that, started by students, that these large, multi-billion-dollar endowments start to really look at their carbon footprints and start to divest of those holdings in these large portfolios that are obviously continuing to damage the environment. And the industry has come a long way. There are a number of different indexes that have been developed over the years to measure companies against these 3 criteria. MSCI, Morgan Stanley, basically their composite index is probably the premier index that looks and tracks companies across and grades them on these 3 areas. What I'm going to share with you today is an analysis that we do as we take a client's portfolio and we basically evaluate it across all 3 of these evaluation topics, and then show you briefly what your score comes out as. And the thing to understand is that the index itself, the MSCI ESG index, includes all 3 of these criteria, but it includes basically investable assets, right? Companies who we have the data on. So it's not perfect, but the index itself has a score. And so the information I'm going to show you is we're going to look at your portfolio across both equities and fixed income and see how your score compares to the MSCI composite index, and where there are opportunities to make improvements. So I'm going to start there. There's an opportunity to dig deeper into it. I will tell you from a carbon footprint perspective, you're considered average. So what does average mean? The report that you will be receiving will have a whole glossary of terms and indices and what it all means. And I'm going to just try to dumb it down for you and say, your average right now, yes, there are areas to improve. Northern Trust on our platform has a variety of ETFs that do have, you know, an ESG and specifically a carbon footprint component to it, screening out those companies that have lower scores. That could have an impact on your score in terms of the overall portfolio. The other thing I would say is this whole area, as I said, continues to be controversial. Just so you know, screening out companies when you have a highly diversified portfolio is an expensive proposition. Typically, larger multi-billion-dollar institutions can do it. When you're talking about smaller portfolios, the way you really have to do it that's cost effective is to say, well, let's take this fund or that fund out and replace it with this fund or that fund. It's very hard to be a purist about it. So that's where we are now. So let me share my screen again and see if I can pull up the right one. Okay. Okay. Can folks see this?
Yes.
Okay. So again, this is looking at your entire portfolio. And here's a summary scorecard. Okay, so here's your portfolio. And of all of the companies that are in the funds within your portfolios, the data coverage is considered about 84%, which actually is a very high number in terms of the data availability. The index itself actually, just because what you have is you have more weighting towards companies where there's more information on, the index itself only covers about 81% of the universe. So consider this to be the universe of investable assets. The numbers over on the right here sort of grade the companies in the portfolio and shows you where sort of you come in terms of the universe ranking. So your number is the dark green versus the lighter teal color. So you're considered an A. In other words, you're sort of in the middle of the pack in terms of overall criteria. Remember, I said environmental, social, and governance. So that's sort of a scorecard. And down here, it basically is saying that your overall ESG ranking is about 27.1% in terms of exposure to the leaders, okay, the green folks here. And you're running slightly ahead of the composite itself, okay? So that's good news. Again, it's a function of the number of companies that are identified within the funds that you're invested in. Okay, and this measure down here is just sort of directionally momentum. I'm not an ESG expert, but my sense is it means what direction are the companies that you're invested in moving towards. Looks like those that you're invested in have a higher score than the composite itself. So they're taking the right actions overall. I'm going to stop here a minute. There's a lot of data, but I think what I'm showing you this so you understand the methodology, and then we'll, today or in the future, kind of figure out where we need to go. Here's another snapshot of it, and it looks at it by these three scores. And again, environmental, social, and governance, and the rank, it's from 0 to 10. So in environmental, you're slightly behind the composite. In social, you're behind, and in governance, you're ahead. And the definitions of all of these are in the appendices of these. So I don't think we have the time to go through them today, but there's a lot of information here and a lot of education required, but this is basically how you stack up. And if you go down here again, you will see the similar ranking. So this is telling us that where you would want to go with the portfolio overall is you would want this dark teal, you would want that to be greater. So this is good. For example, this is saying that your percentage of companies that are considered strong in this AA category is 20% versus the composite, which is 14%. Let's go to the environmental risk exposure, because this, I think, is the one that's most pertinent to the conversation today. So as I mentioned, your portfolio right here, your score, let's look at this carbon intensity score here, there's 173, and this is companies, excuse me, that are in the composite, and we're comparing it to 159. This is where you want to be. So it's basically saying the portfolio's carbon risk is moderate and higher than the composite. So you are you're here right now, okay? And I'm probably not explaining this very well, but you know, the question is, how do we get you in terms of fossil fuel reserves and the companies that are in the portfolio? How do we move you even further to the left? Okay. Now, I was asking the people who do this for us, like, well, what does this whole chart mean here? What is this telling me? This is telling us that of the total composite, you know, there are some who have companies that still have a long way to go. As far as getting into, you know, reducing this. So, you know, from an industry perspective or from an investable universe perspective, right, we want to see this improve. We want to see this shrink. And so we would also want to see your number shrink too, in terms of the number of companies that have high or very high risk component to them. So again, it's sort of counterintuitive, but what we're trying to do is say, what could we do to improve the portfolio? So again, it's doing a little better than the composite right now. How could we make it even better? Okay. So again, a lot of information in this deck. So there's some numbers are important, some aren't, but the overall notion is, you know, you're doing okay, right? You're not egregious in any way. You're sort of keeping pace with the overall industry in terms of investable assets and how your portfolio stacks up against others. I'll just show you what's in the, so you can look here in terms of your holdings, and this is what's in the report. It's showing you your top largest holdings and what their scores are in terms of the funds. So again, we look under the hood, we understand all the companies that are in each of these funds. And overall, the fund has this rating. Looks like this iShares EFA fund has a higher score. Looks like this high yield fund, which isn't surprising because high yield in general has a larger percentage of energy companies. You know, it's a triple B, which is not a good score. And again, if we look down here in terms of your overall, we would look to say, well, let's compare to what we could do to the portfolio. The goal is to try to figure out what would we replace here to, how could we improve this profile of companies to get you further to the left, again, do better than even the composite itself. And so I encourage you to look through this, because it's not necessarily intuitive, but this is how the industry overall in terms of ESG profiling of investment portfolios works. There's a grading system that's been highly developed by MSCI over the years. And you can take different portfolios and kind of put it through and say, how do if we're invested in funds, how do the individual securities under those portfolios, how do they look? And what is the general ranking? And you're right here leaning towards, you have more leaders than you do laggards for sure. You don't have a lot of laggards in the portfolio. Okay. So finally, what I've included in the attachments are a couple of different, go back to the portfolio to say a couple of different things that we could use to replace these funds with others that have higher scores. Okay. And the next step would be to say, could we, you know, how do we improve those? And what I'm going to show you next is basically there are 3 funds where they've already right out of the gates have basically reduced their carbon footprint by about 25% versus the index. So that's what you want, right? You want to take some of these core index strategies that you already have. The performance, some of them are younger than others. I would say they're, some years they're better, some years they're worse. But overall, that's sort of where you'd want to go. And I can spend time looking at those funds now, but I think it's more important that the committee first decide whether they want to move in that direction and have us make a recommendation to say, if we wanted to replace these funds, how much do you want to move to the left? It's impossible to be pure, but that's the direction we would head in.
Right, thank you, Bonnie. Are there any questions? for Bonnie? Jeff, over to you.
Okay, so back in the packet, page 166 is a one-page summary that I prepared for Jeremy. So let me start by, I'm going to read from, I think this is your investment policy statement.
Yep, I'm just pulling it
Yes.
up. I'm glad someone brought it.
Right. So it says, in addition, the city shall not purchase any investment issued directly by a corporation that engages in the exploration, production, drilling, or refining coal, petroleum, or natural gas. So first thing I would say, and I'm not a lawyer, but in these portfolios, you are not purchasing any investment issued directly by a corporation. These are all mutual funds. So right there, you're not in violation of the letter of the law. I'll use the word law. However, the spirit is different, and I think that's the issue. So what I did was I just took a look at the existing investments that you've got. What kind of energy sector exposure do they have right now? And what are the expense ratios? What's the fee on those funds? And then I looked at, and these are just examples of potential alternatives that would have no or at least low exposure to energy or fossil fuels. And what do those cost? You can see the equity funds, the cost goes up a pretty good bit, 20 to almost 40 basis points.
100 basis points, yeah, the Boston Trust Walden Fund.
On the bond side, you can actually get off pretty even from a cost standpoint, because there are fewer ESG bond funds. This is a relatively new area, but they do exist. Interestingly, Boston Trust, your small cap manager, they have another arm of their organization that does socially responsible investing. It's called Boston Trust Walden Products. So they have the exact product you have, except with these screens applied to it. But it's 25 basis points more. And you can, for an index fund, instead of a 500 index, Calvert's got an index fund. That's 24 basis versus 4. So to do this would cost more. And again, it wouldn't have to be these particular funds, but I think these are representative examples of that. So I would say is that you want to pay that cost. And again, performance is going to vary. We saw this quarter, you wanted energy. That was pretty much the only thing you wanted. Last year, that was pretty much the only thing. But in the first half of this year, you didn't want it. So it's gonna come and go. But the cost is the cost. And that's a no factor.
Obviously, that's the word.
Right. Now, if you want to make the argument of, by not having these wasting assets, these energy companies, our returns will actually be better. So we'll more than make up for that extra cost. That you can make that argument, but nobody knows.
So these are all the fund. These are not in the cemetery fund, which I was just reviewing with you.
Yeah, these are just the ones in the other portfolios.
All right.
Thank you for presenting these items, Ms. Bonnie and Mr. Depp. Are there any questions or comments from the commissioners, the directors, the attorney, or staff?
I'm just trying to think of next steps in relation to this particular topic. Do you guys like the attorney of the commission? Okay. So I think maybe perhaps what we could do is, Ms. Bonnie and Mr. Nip, perhaps I should reach out to the council member who brought this up and we could do a briefing that included the two of you. To see, because I do think that there are pros and cons, right? There's going to be a cost, I think, overall in earnings, in the long run. So I think maybe having a more comprehensive overview of the composition of our funds could be beneficial. And then also just, again, discussing like what the potential options would be to see if it's possible. So let me kind of kick that around and then you can come back to the commissioners should there be this will to proceed.
I think that the presentation that Ms. Bonnie had that showed where we fall on that spectrum
Is there?
of ESG is definitely going to be a positive, for us not making big moves.
Right,
Yeah,
right.
great. Okay. Ms. Bonnie and Mr. Nick, thank you again for providing the Funds Commission with this information. Note for the record, these are informational items. There will be no commission action. That includes informational items. On our agenda today, we have 2 action items today. The first action item under consideration is item number 1, investment policy statement updates implement the investment requirement for Mount Hope Cemetery Fund. And I'll pass it over to Ms. Bonnie to present this action item.
Well, I believe it's an action item. So for purposes of Brown Act, we have to place items that are potentially going to be an action of committee from this conversation. Is that the only action item we have?
It's 2 action
I would
items.
A similar one for the funds that we work on.
I would recommend trailing action items 1 and 2 for the, I guess, the evaluation of the current investment policy for those 2 until I've had the opportunity to meet with the council member, kind of brief them. We can do that other conversation and potentially bring that back to the commissioners at the next board meeting.
Okay, so strike action items.
Yeah, I don't know what legally how we do that to put it on the record. I think that just trailing those 2 action items for now. Continuing, thank you.
Do we need to vote on that? We're not doing anything, so.
Vote to not do anything.
I mean, they do vote actually to continue items, so we could.
Okay, so we will continue these 2 action items until the next meeting. So let's continue.
Motion to continue.
I'll
Commissioner
second.
Dunfield,
I will second the motion to
let's bring a
continue.
second, and we unanimously voted to continue these 2 action items to the next meeting. That should satisfy the Brown Act on there. So let's move forward. We will skip over the action item there. Let's move on to. Well, that was it. So non-agenda public comment. At each meeting, we invite public comment for up to 3 minutes about issues within the commission's jurisdiction not on the agenda. This afternoon, we have 0 speaker slips turned in for non-agenda public comment. So now we can move on to the next meeting date. Mid to late February 2024. It was today's.
Today's the third, or the 30th. Oh,
All right, how about February 29th?
I think it's leap day. That'd be special. It's my dad's birthday. He's gonna be 84, so we should be. on.
He's actually born in February.
Mhm.
Wow. Andrew, will we have access to this room?
Yes, it was.
Yeah, we'll check.
Perfect. February 29th at 1:30 seems to be okay with everyone.
So far. I'll-
First time ever.
Wow. Amazing. Okay. So next meeting will be February 29th, 1:30 PM here in the main library.
Thank you, everyone.
Okay, this brings us to the end of our meeting. The next Funds Commission meeting is scheduled for February 29th at 1:30. Meeting adjourned at 2:32 PM. Thanks, everyone.
Thank you.
Thank you.
Thank you.
Very efficient.
Hey. Well,